Silver ready to explode Friday? Massive divergence plus Hormuz update. Something is building in the silver market right now that most investors are completely ignoring. And if you understand what I'm about to show you, you'll realize why this Friday could be one of the most important trading sessions silver has seen in months. There's a divergence forming, a massive one, the kind that historically precedes violent price moves. And layered on top of that, something is happening in the Strait of Hormuz that the mainstream financial press is barely connecting to precious metals. Stay with me, because by the end of this video, you'll see exactly what smart money sees right now, and why most retail investors won't understand it until it's too late. Here's what we're going to cover today. First, the divergence. I'm going to show you a technical and fundamental split forming in silver right now that has historically preceded significant breakouts. Not always, but often enough that you need to know about it. Second, the Hormuz factor. There is geopolitical stress building in one of the most important shipping choke points on the planet, and almost nobody is connecting that story to silver's industrial demand profile. Third, what Friday specifically means for this setup. Options expiration, COMEX positioning, the technical levels that matter, all of it. Most investors are looking at silver as just another commodity reacting to the dollar. That's the surface level read, and it's incomplete. The investors who understand the deeper architecture of this market, they're not confused right now. They're watching, they're waiting, and some of them are already positioned. Let's build that picture together. Section 1, the divergence. Let's start with the divergence, because this is the core of today's setup. When most people hear the word divergence in financial markets, they think of a simple chart signal. Price going one way, an indicator going another. That's part of it, but the divergence I'm pointing to here is deeper than that. It's operating on three levels simultaneously. Level 1 is technical. Silver has been compressing into a tightening range, while momentum indicators, particularly relative strength and volume-weighted signals, have quietly been strengthening. What that means in plain language is this. The price has been going sideways or slightly down, but the underlying buying pressure has been increasing. That's a classic setup for a release, a snap, a move that feels sudden to most people, but was actually loading for weeks. Level 2 is the gold-silver ratio. Right now, the ratio remains historically elevated. That means silver is historically cheap relative to gold. Every major bull run in precious metals over the last 4 decades has eventually seen that ratio compress, meaning silver outperforms gold in percentage terms. The ratio doesn't snap back overnight, but when it does move, silver's gains tend to be asymmetric and fast. Think about this for a moment. If you believe gold is in a structural bull market, and the price action over the last 18 months gives you good reason to, then silver at these ratio levels is either a massive opportunity or an anomaly that needs to be explained. And right now, there's no fundamental reason the anomaly should persist. Level 3 is the most important divergence, and the one almost nobody talks about. Is the split between paper silver and physical silver. The paper markets, futures, ETFs, synthetic instruments, have been under selling pressure. But physical demand from industrial buyers has remained strong, persistent, structural. That split between paper and physical is not sustainable indefinitely. At some point, the physical demand has to reprice the paper. And when that reconciliation happens, it tends to be sharp. Here's the question you should be sitting with right now. If physical demand is strong, if the ratio is historically stretched, and if technical momentum is quietly building, what is actually holding the price down? The answer to that question is the setup, and that answer connects directly to Friday. Section 2, what Friday means. Let's talk about the calendar, because timing matters here. Options expiration cycles in the commodities market are not random noise. They are structured events with predictable pressure patterns. In the weeks leading into expiration, there are concentrated incentives, particularly for large institutional participants on the short side, to keep prices pinned below certain levels. This is not a conspiracy, it's mechanics. If you've sold calls at a certain strike, you want the price to stay below that strike through expiration. That creates what traders call max pain pressure, a gravitational pull toward a price level that benefits the most option sellers. But here's what happens after expiration. That artificial gravitational field disappears. The pressure that was suppressing the price releases, And if there's underlying buying demand, which in silver's case right now there clearly is, the price can move quickly once that cap is gone. Friday is that expiration, and the specific technical levels that matter right now sit just above where silver has been trading. If silver clears those levels with conviction on Friday, or in the sessions immediately following, that technical break has the potential to trigger a cascade of short covering. Shorts who are positioned for expiration suddenly have no reason to maintain those positions. They buy to cover. That buying creates momentum. Momentum attracts more buyers, and the move feeds itself. This is not guaranteed. Markets always have multiple paths, but this is the specific mechanism by which Friday matters to the setup. It's not just another trading day. It's a potential inflection point where the mechanical pressure changes direction. And now I want to add the geopolitical layer, because this is the piece that makes the setup feel genuinely urgent. Section 3. The Hormuz factor. The Strait of Hormuz is 21 miles wide at its narrowest point. Through that 21 miles flows approximately 20% of the world's oil supply. 20%. Most people know that. What most people don't connect is what that choke point means for silver specifically. Here's the mechanism. Hormuz stress. Any serious escalation in the geopolitical tension around that waterway does three things simultaneously that all converge on silver. First, it spikes energy prices, oil and natural gas, and energy prices are directly embedded in the cost of mining silver. When energy costs rise, the cost of production rises. The break-even price for marginal silver production moves higher. That's a fundamental floor price support that most retail investors never think about. Second, Hormuz stress triggers a flight to safety. Gold typically gets the initial bid in those moments, but silver, especially silver at an historically wide gold-silver ratio, tends to follow with a lag, and when it follows, it often moves harder in percentage terms. Third, and this is the layer that most analysts completely miss, Hormuz stress threatens the industrial supply chains that depend on the Gulf region's economic stability. The downstream effect on manufacturing, on electronics production, on the solar supply chain, all of it creates procurement urgency. Industrial buyers of silver don't speculate on price. They buy what they need to keep production running. And when supply security becomes uncertain, they buy ahead of need. That's additional physical demand pressure on top of everything else. Right now, as of this recording, the situation around Hormuz is not a crisis, but it is elevated. The diplomatic channels are strained. Naval posture in the region has shifted, and the market is not pricing any meaningful risk premium into that situation. That is the divergence between geopolitical reality and market pricing, and historically those gaps don't last forever. Let me be precise here. This isn't a prediction that Hormuz closes tomorrow. That scenario is low probability. But the relevant question for silver investors isn't what's most likely, it's what's most asymmetric. And a market that is pricing near zero geopolitical risk into an elevated tension environment, that's an asymmetric setup. The worst case, if tensions de-escalate, silver gives back a small risk premium. The upside case, if tensions escalate further, energy costs spike, safe haven demand floods in, industrial procurement accelerates, and silver, already set up technically with that divergence in that ratio, moves violently. That asymmetry is worth understanding. Section 4. The macro architecture. Let me zoom out now, because the Friday setup and the Hormuz factor don't exist in a vacuum. They sit inside a macro architecture that has been quietly constructing itself for the last several years. And when you see that architecture clearly, the individual pieces stop looking like noise and start looking like signal. Here's the architecture. The global monetary system is under structural stress. The dollar's share of global reserves has been declining, not collapsing, but eroding, slowly, persistently. Central banks in the emerging world have been adding gold at a pace not seen since the 1970s. That's not coincidence. That's a deliberate diversification away from dollar-denominated assets by sovereign institutions that have studied what happens to reserve currencies under sustained debt expansion. The United States is running deficits that are structural, not cyclical. That means they don't go away when the economy grows. They're embedded. And the math of compound interest on a growing debt base eventually produces a moment where the cost of servicing that debt crowds out everything else. The Federal Reserve is caught between two bad options: fight inflation with high rates and risk breaking the debt service math, or allow easier financial conditions and risk reigniting inflation. Neither path is clean, and both paths, historically, have been resolved through some degree of currency debasement. Currency debasement, the slow erosion of purchasing power, is the oldest solution to sovereign debt stress. And the historical beneficiaries of currency debasement are always the same: real assets, commodities, precious metals. Now, inside that architecture, inside a world where fiat currency is being structurally diluted, where central banks are buying gold, where industrial demand for silver is rising from electrification and AI infrastructure build-out, where does silver sit? Silver sits at the intersection of monetary demand and industrial demand. It benefits from both simultaneously. Gold gets the monetary demand. Copper gets the industrial demand. Silver gets both. And it's priced like it's getting neither. That structural mispricing is the foundation underneath everything else we've talked about today. The Friday setup is a trigger mechanism. The Hormuz factor is a catalytic accelerant. The macro architecture is the reason the move, when it comes, has room to run far further than most people expect. Section 5. What smart money is watching. So what are the specific signals that matter from here? Let me give you the framework that serious silver watchers use to read this market. Signal 1. COMEX registered inventories. The registered category represents silver that is available for immediate delivery. When registered inventories decline, it means physical silver is being pulled out of the system. Watch this number. A sustained decline in registered inventory while open interest remains elevated is a stress signal for the paper market. That stress eventually resolves through price. Signal 2. ETF flows. Silver ETF inflows don't just reflect retail sentiment. They reflect the physical market because major silver ETFs must hold allocated metal. When ETF inflows accelerate while the price is still in a compression phase, that's accumulation. That's smart money building positions before the breakout. Signal 3. The dollar index. Silver is priced in dollars. A weakening dollar creates a direct mechanical tailwind for silver's nominal price. Watch the DXY. Not just the level, the direction, and the velocity. A dollar that breaks below key technical support has historically accelerated silver moves already in progress. Signal 4. The gold breakout confirmation. Gold has been making new highs. When gold makes new highs and silver lags, as it is right now, one of two things is true. Either gold is wrong and will correct back down, or silver is wrong and will correct sharply upward. Given the physical demand environment and the macro architecture we've described, the probability distribution favors the latter. Signal 5. Geopolitical news flow. Specifically, anything coming out of the Gulf region, anything related to BRICS monetary developments, and anything related to Federal Reserve policy signaling. Any one of these could be the external catalyst that breaks the current price compression open. You don't need all 5 to align, but the more of these signals that start moving simultaneously, the higher the probability of a significant price event. Here's where we are. Silver is sitting inside a technical compression with building momentum. It's priced at a historically stretched discount to gold. Physical demand is structurally elevated. The Strait of Hormuz is carrying elevated geopolitical risk that the market has essentially ignored. Friday's options expiration removes a key source of artificial price suppression. And all of this sits inside a macro environment where the long-term case for real assets has arguably never been stronger. None of this means silver explodes tomorrow. Markets are never that simple. But here's what I know. Every major silver move in history was invisible to most investors until it was already happening. The breakout looks sudden, but the setup had been building for months, quietly, methodically, just out of view of anyone who wasn't paying close attention. The people who captured those moves weren't smarter than everyone else. They were earlier. They understood the architecture before the crowd did. They were sitting in position when the catalyst arrived, not scrambling to chase price 3 days later. I'll ask you one question to close with. If the macro is structurally bullish, if the setup is technically loaded, if the geopolitical environment is more volatile than the market is pricing, what is the cost of paying attention right now? Because the one thing I know about silver at this stage of the cycle is this. The moves that matter most in this market do not give you time to think. They give you time to act or time to regret. Which one are you preparing for? Watch for the follow-up, because if Friday delivers the move this setup is pointing toward, we'll need to talk about what comes next. And what comes next may be the real story.